today's explainer. We've got a high-energy, packed agenda for you right before the opening bell. We're going to break down the latest global macro trends, your tactical currency levels, and the key drivers pushing equities. If you're looking to get a clear, structural view of exactly what happened overnight and what it means for your trades today, well, you're in the right place. Let's cut the noise and get straight to the charts and the actionable levels you need to know. So let's kick things off with a number of the day, which is the hook for our entire session. 24,344. Yesterday, the Indian markets finally had a session where the bulls just didn't need a rescue team. The Nifty officially broke out and closed above this absolutely critical 24,344 resistance level. It's a massive signal of momentum. We'll break down exactly what drove this breakout in just a minute. But first, let's zoom out and jump into our global macro wrap. Check out this stark policy contrast playing out right now between central banks. Markets are frantically dialing back expectations for aggressive Federal Reserve tightening. In fact, they're now pricing in less than 1/4 point hike for 2026. Crazy, right? Meanwhile, the European Central Bank is in a completely different headspace. ECB officials like Isabel Schnabel and Philip Lane are keeping things firmly in a wait, watch, and worry mode. They're seriously concerned that geopolitical risks, elevated gas prices, and even the surging electricity demand driven by AI are going to keep inflation uncomfortably high. And speaking of geopolitics, we've got an interesting dynamic unfolding. In the Middle East, Iran's mourning period for Ayatollah Khamenei continues. Donald Trump even noted that neither side would fire during this 7-day window. Meanwhile, Hamas has actually dissolved its civilian governing authority in Gaza, so a calm holds, but with a pretty massive asterisk. Peace in the region still feels like the world's longest work in progress. Wall Street, on the other hand, they are completely shrugging off any recession headlines. Investors are incredibly optimistic about semiconductor partnerships and the upcoming earnings season. AI is still running the show here, which just pushed the Nasdaq up over 1%. Okay, let's shift gears to see how this macro backdrop builds into our tactical currency matrix in the major currencies and FX playbook. Starting with the US dollar, here is the soft point catalyst driving the action, 54.0. The US June ISM Services Index eased down to this level, signaling a modest deceleration in the expansionary trend. It's softer, sure, but still healthy. And honestly, this is exactly why the markets are repricing the Fed to be a lot less hawkish right now. So how does this translate to the charts? For the dollar index, the DXY, we basically saw a flattish day. Gains in the pound were offset by losses in the yen. Your key resistance to watch is up at 101.41. On the downside, keep an eye on support at 100.89, with the pivot sitting right at 100.47. Tactically speaking, this remains a low-conviction buy on dips while we sit on our hands waiting for the U.S. ADP jobs data, trade data, and Atlanta Fed GDP updates dropping later today. Moving over to the euro, we actually have a really surprising fundamental backdrop. German factory orders unexpectedly rebounded in May, jumping up 1.9% month over month. That comfortably beat consensus estimates. But despite that good news, and despite the ECB's Schnabel warning everyone about strong core inflation, the Euro-USD pair basically just traded flat. Let's hit those technical levels. Resistance sits at 1.1447, and above that, 1.1483. Support is down at 1.1388. The main takeaway here is our tactical view. Right now, selling on the rise just doesn't offer good risk-reward. Now, setting up the British pound, you need to brace yourself for a seriously heavy data slate today. The UK 10-year yield is staying sticky and flat, consolidating after it jumped 6 basis points last week. Today is going to be heavily driven by the Bank of England's financial stability report, the MPC meeting minutes, and a speech from Governor Andrew Bailey. And this brilliantly illustrates exactly why cable continues to outperform. The pair officially broke through its pivot at 1.3368. Because of that break, if you look at a daily time frame, this pair is a clear buy on dips. Your upside resistance targets are 1.3393 and 1.3450, with support firmly planted at 1.3326. Over in Japan, though, we are seeing a totally different kind of drama. Take a look at this number, 2.830%. Japan's benchmark 10-year JGB yield rocketed up 6 basis points yesterday to hit a fresh 30-year high. This surge is reflecting some serious mounting domestic anxiety over how the Japanese government actually plans to finance its multi-trillion yen public-private investment programs. Add in the fact that household spending data came in much better than expected, and you have markets aggressively testing the Bank of Japan's intervention resolve. So for USD/JPY, we are advising extreme caution. You really need to stick strictly to tactical breakouts here. Only buy on a break of 162.71 or sell below 161.94. And whatever you do, please use very tight stops. All right, let's bring it back home and pivot our focus to the domestic Indian markets for the rupee and Nifty playbook. Starting with the rupee, the currency actually slipped to a 3-week low, touching an intraday weak point of 95.4750 per dollar. A broadly upbeat dollar is pinching a lot of Asian currencies right now, but more specifically for India, a revival of corporate arbitrage trades and maturing non-deliverable forward contracts are completely outmuscling the heavy intervention and support we're seeing from state-run PSU banks. So here are your actionable levels for USDINR. It closed at 95.3950. You've got immediate resistance holding at 95.43 and then up at 95.82. On the downside, support levels are at 95.21 and 94.92. Tactically, the view remains that those PSU bank sales are effectively capping the intraday weakness and preventing further losses. Now, let's circle back to our opening hook, that massive Nifty breakout. We are seeing some incredibly positive tailwinds driving Indian equities right now. Strong quarterly updates from private banks completely anchored the momentum, dragging realty, auto, and consumer durables along for the ride. Meanwhile, the IT sector politely sat this one out on the sidelines. Crucially, the RBI bond yield slipped below its 200-day moving average, which hints at easier financial conditions ahead. Plus, the monsoon deficit narrowed significantly, going from 43% down to 24%, which is heavily cooling our food inflation worries. To cement the technical view for the Nifty, the index opened at 24,306 and maintained a really positive bias all day long. With that final close above the 24,344 support, our tactical view is totally reaffirmed. Buying on dips remains the absolute optimal strategy here. Your next resistance target to watch is 24,561. Below that, your safety nets are 24,344, and then all the way down to the 21-week moving average at 24,008. Finally, let's look ahead and put a spotlight on today's radar. We have a heavy slate of macroeconomic data dropping today that is going to dictate both the European and US trading sessions. You need to make sure you're positioned for the Bank of England data drop, the crucial US ADP employment report, the US trade balance, the NY Fed's one-year inflation expectations, and that Atlanta Fed GDP Now update. Every single one of these releases carries the potential to sharply move prices. Which leaves us with a final, provocative thought to chew on. As markets spend every waking hour frantically recalibrating their expectations for the Federal Reserve, you really have to ask yourself, was one jobs report not enough drama for the week? Keep your stops tight, watch those charts closely, and navigate this volatility carefully. Thanks so much for joining me for this explainer, and we will see you next time.